Good evening, good afternoon, or good morning, depending in which time zone you're in. This is Rustam Vahitov and David Borinsky on the fourth lecture of our series, ITC Leiden Alumni series of international tax. David is going to deliver an amazing lecture on very hot topic of US international tax news. Everyone is curious about what is going on in the US. David is a graduate of ITC Leiden program, and he is founder and president of Inbound USA, Realty, US-based firm offering tax and business expertise on to international investors who would like to buy real estate in the United States. David obtained a bachelor degree in economics and law degree of University of Virginia, and David is also holding master degree in US taxation from New York, and finally master degree in international taxation from International Tax Authority Leiden. As always, please feel free to ask questions. Please feel free to drop some comments, preferably in question and answer section. But if more convenient, you can also use chat. Although this is less efficient, as we would be looking first in question and answer section. Well, that's pretty long introduction, David. Please, the floor is yours. Please tell us what is going on in the US.
Okay, well, if I knew, I would tell you, but I will do my best nonetheless. Thank you, Rustam. It's a pleasure once again to participate in a program of yours. What I'm going to do, for those of you that are too quickly falling in love with my beautiful face, is share screen, so the 98% of the lecture will be delivered with a PowerPoint slide on the screen. I hope that adds rather than subtracts to the usefulness of the presentation. So I'm going to do that right now. Trying to get the full screen. Why is it not doing full screen? Goodness, Rustam, we just did this.
This is a little screen. Yeah, you're almost there. You have been. If you move the pointer to the left, this is the first sign next to this
with apologies to everyone.
No problem. We'll just rewind. We'll just edit this record.
Okay.
Yeah, that's it. Good.
Okay, U.S. developments in international tax. There are bad news and good news. I apologize in advance for the excessive effort on my part to be funny unsuccessfully. The first try is using bad news and good news. The bad news is that I'm going to give a brief summary of some of the provisions of the 2017 Tax Act, the BEAT, GILTI, Fdii, and all that. That's the bad news. The good news is that you don't have to understand any of it or remember any of it, and there will not be any test. The reason why I'm going through that is because it is so complicated that you almost, there's an expression, you know, if you're not confused, then you don't know what's going on. So that's really the purpose of investing 5 or 10 minutes or however long I take to go over the BEAT and GILTI and whatnot, because it's a very essential to have that context to understand what the current policy and political dynamics are in the US on matters relating to international tax. So let's get started with that. Okay, control. So I'm going to just go through these. Again, don't feel that I'm patronizing you. I'm just giving a context here so that we can discuss the things that are happening today. So this is by way of background again. So the basic concept that underlies both the pre-2017 international tax rules for business taxation and such, and post-2017 is the notion of controlled foreign corporations, which of course is familiar to tax practitioners in all major trading countries. So a non-US corporation, which is more than 50%, I see I have a typo there, 50% or more owned by number, value, directly or indirectly by US shareholders, and indirectly can mean either through an intermediate corporation or through family members and the like. Okay, so the US tax system is worldwide with respect to US taxpayer, be it an individual or an entity, although it is mitigated, as I'm sure everyone on this seminar knows, by certain income exclusion and foreign tax credit rules. So it's, if you're a US resident or US citizen, a US resident or a green card holder who's in the US for 183 days or more, you're taxed on worldwide income, but of course, depending on the rules, you either get a tax credit or income is, well, from the US standpoint, you wouldn't have an exemption, but, and then there are many other rules that apply. It is territorial these days after 2017 with respect to income earned by entities other than transparent entities. If you have a entity taxed in the US as a partnership, then you're taxed as if it's you're subject to worldwide income. I'm in an office and I don't want to. Okay, pardon me. So the important thing is that it is now after 2017 territorial. However, there are exceptions, and it's almost at the point where the exceptions swallow the rule. So we're starting within concept a territorial thing, but given the BEAD and GILTI and the so-called SHIELD proposal that the current president has proposed, it's very much a mix of territorial and worldwide scope. So before 2017, with the those even more complicated rules, we had the simply complicated Subpart F income rules. And Subpart F income is non-US sourced income, which is either passive income, dividends, interest, royalties, rent, or it's service or sales income that involves related parties, unless it's all in state. If you have a US entity, if you have a US entity operating in Great Britain and it's buying and selling from a sister corporation in Great Britain, as long as there's actually a business going on, then the Subpart F rules are not going to capture that income. They're going to let the Brits impose their tax, and then the US would just, to the extent appropriate, allow for a tax credit, although I don't, just thinking through how that would go, it wouldn't apply on those facts. The point is, if it's either passive income or it's income in another country where the multinational is gaming the system and using shell entities or entities that don't really conduct business, then it's Subpart F income. So in 2017, the Congress passed and the president signed the Tax Act that added some interesting overlays. Here, hopefully as quickly as possible, I'll go through. The GILTI is essentially intended as an anti-abuse rule. You generally use the controlled foreign corporation rules to determine income, except you make certain adjustments. The first obvious one is that if it's already considered Subpart F income, then it's not guilty income because you've already dealt with that with a special rule. And then they also take off a 10% return for sort of a deemed return on tangible assets. So you take, if you have $100 in total income in this entity that is a non-US entity that's owned by a US parent, you take off the you take off the subpart F income, you take off, take a 10% return against assets and knock that off. And then you have your guilty income. You then can deduct, if you're a corporate US corporate shareholder, half of that. So if you've got 100 of income and 30 of it is subpart F income, that's 70, and then you get a return against assets, and now your guilty income is down to 65. In addition, assuming that the US shareholder is a corporation, the 65, you get to deduct 32.5 from that. So you end up with $32.5 of guilty income. And then that is taxed in the US as if it's realized and recognized in the US. And then just as a completely too much information aside, if you can't use foreign tax credits that also apply, then you, well, first of all, you only get to use 80% of the foreign tax credit, unlike almost every other set of facts. And also there's no carry forward or carry backward, if that were otherwise applicable, of the unused foreign tax credit. So now that's all you're going to hear. Well, you're going to hear more about guilty, but that's all the tiresome teaching you're going to get on guilty. President Biden has proposed eliminating the 10% return and then tightening up the rules relating to what can be deducted. And to be honest with you, those are differences of, let me jump ahead and say a lot of what's going on with US tax policy is informed by and shaped by intense political motives, left and right, as we will see in later slides. With respect to the changes that Biden is proposing for guilty, they're really not too political. I have my own preferences, but I would view someone disagreeing with me as utterly acting in utter good faith, purely from a policy standpoint. So another tiresome, hard to remember, hard to understand concept is FDII, foreign derived intangible income. It's intended to give favorable treatment of income deemed to be generated using intangibles, and it's essentially, again, using that same 10% return adjustment, you know, where the first 10% is just, for those of you that are transfer pricing junkies, that's just sort of like a, call it a Part B or Part C under the Pillar 1 thing, just a sort of base return that's eliminated from the calculation. And then unlike the 50% deduction that corporate shareholders get for guilty, it's a 37.5% deduction. And then Biden, switching now to what President Biden is proposing, he proposes repealing the deduction. So that is really just an increase in taxes. His administration is saying, oh, we don't think it's a well-designed program for encouraging the use of US-based intangibles. We're going to use all the savings from that, barring that 37.5% deduction, the entire additional cost to corporations, we're going to use that to give R&D tax credits and other such things. I think if you believe that, then I have a bridge in Brooklyn that I think I could get, that you can buy for a very good price. The government never when it promises to earmark money, it promises to say, well, we're going to increase taxes and use all that money to help widows and orphans. And of course, they don't use it for widows and orphans. So that's going to happen there. But in any event, that's the change in from the 2017 Act relating to intangible income derived from the conduct of non-US businesses by a US business. BEAT is probably the area where the most contention is arising these days, BEAT is beat erosion and anti-abuse tax. It mostly affects corporations which either incur substantial expenses owed to non-US affiliates or that qualify for substantial tax credits. So it really is just a rule that says you're just, whatever it is you're doing, we don't care, but you're doing too much of it. So, and it only applies to big companies defined as having $500 million per year in revenues averaged over, over a 3-year period. It imposes essentially a minimum 10% tax. So if you say, I don't care what you're doing, but you're doing too much of it. So then you'd go through a calculation of what too much is, and it's a mechanical inquiry. And whatever the too much portion of what, if you have expenses owed to non-US affiliates, and it's out of that $50 of expenses, you think 30 of them are reasonable, but 20 of them are just too much. So the too much amount, the 20, is taxed, has an additional 10% tax imposed against it. Now, Biden proposes repealing BEAT and replacing it with SHIELD. And I know those of you that don't immediately know what the acronym SHIELD stands for are embarrassed, but we will not ridicule you in front of your colleagues if you don't know what SHIELD means without having to even think about it. But that's a joke, by the way. Okay, SHIELD is stopping harmful inversions and ending low tax developments. For those of you not from the US or not from a Anglosphere country, the Magna Carta is the sort of founding, the beginning germinating document representing what English-speaking peoples take a lot of pride in as viewing as, a tradition of freedom and rule-based governance and so forth. So you get the Magna Carta, you have the Declaration of the British Parliament in 1688, the Declaration of Independence in the US, the Bill of Rights of the US Constitution. We have advanced in our sophistication in the Anglosphere to the point where we now have such grandiose initiatives as, instead of the Magna Carta, we now have the Stopping Harmful Inversions and Ending Low Tax Developments. I would say that's pathetic, but that's because no one's paying me to pretend otherwise. All right, so it replaces BEAT because the latter, BEAT, is viewed as both over and under inclusive. And that is a fair criticism. As I said, it's really just, you're doing too much of whatever it is you're doing. It doesn't really reflect a judgment about what it is, whether the too much is too much of something that is undesirable conduct or too much of something that's desirable conduct. And it's a mess. Now, it would apply to multinationals with 2 billion, that's a B, billion or more in annual revenue, which I think the Biden staff estimates would cover about 100 firms. The criticisms is that it's got its own inconsistencies. It would allow credits but not deductions in computing the minimum tax, thus encouraging companies to try to shift from deductions to credits, and of course encouraging non-US taxing jurisdictions to shift whatever tax benefits they're offering in that same direction. It's also criticized as a backdoor way to impose an alternative minimum tax. The alternative minimum tax, there was such a thing in the corporate realm, and there is sort of kind of in a way that applies to individual taxpayers in the US. And it's basically another version of, you're just doing too good a job at minimizing taxes. And there were a lot of distortions and a lot of controversy and a lot of clear thinking people that argue that alternative minimum taxes are not good policy. But in any event, if you buy into that, then that's the fact that it's a backdoor to an alternative minimum tax for corporations is undesirable. And also it is viewed that it would discourage investment in research and development, since there are major book tax differences. There are major book tax differences in reporting research and development. The whole patent box arrangement that many countries offer. And in the US, there are very attractive tax treatments for research and development. There's credits, there's immediate write-offs. It's like having a date with Bridget Bardot in a tax sense if you do R&D in the US. So President Biden proposes getting rid of BEAT, and his SHIELD initiative is intended to encourage onshoring of research and development. Okay, anti-inversion rules. This is a very interesting area. It just goes to show you that I need to get a better life, that I find this so interesting. But what was happening is before 2017, the US tax code essentially encouraged multinational firms that had substantial, US-based multinational firms with substantial revenues and profits realized outside the US to just move to another jurisdiction, oftentimes Ireland, but not only Ireland. And it was, I even remember when I was in law school many ice ages ago, I remember just without even knowing much, and other people in the class, we all marveled at how poorly designed the US tax rules relating to C Corps, to the corporations that pay their own taxes. We just marveled at how poorly designed it was. And this was an obvious problem, that it encouraged large businesses to park their earnings overseas. So the 2017 Act did two things that were important. Number one, it gave a window where people could just repatriate, US corporations could just bring their earnings that had been parked and left overseas for years, if not decades, just bring them back to the US. And that there was an estimate that something like $2.1 trillion of capital was repatriated. The second thing, it changed the rules going forward so that, as I said earlier, the US has shifted from a worldwide system to a territorial system. Of course, that's very much qualified by GILTI, BEAT, and then if the SHIELD proposal goes through SHIELD. The proposed new rule, and this is to replace the one that was passed under President Trump's time, the 2017 rule had two thresholds: 60% of the stock by voter value and some other things and so forth, and then another rule for 80%. If it's 80%, it's just if the stockholders of the original pre-inversion corporation are 80% of the owners of the new corporation resident in another taxing jurisdiction, it's just treated as a US resident. So there is the rules proposed by President Biden are actually very defensible. Former shareholders, they just have a 50% or more threshold. But there's an alternate rule, and this is very problematic. And this is something for those of you that have gone to get a second cup of coffee or meditating or falling asleep, you should get back to your seats and pause the meditation. The second way to get in trouble under President Biden's proposed anti-inversion rules are this second bullet point, all three of the following. The fair market value of the resulting entity is larger, and that's may or may not be the case, but it certainly is not implausible. The group is, and this is the important thing, the group is primarily managed and controlled in the United States. Again, for those of you familiar, who have any experience doing battle in the context of transfer pricing, the whole idea of functions, assets, risks, DEMPI inquiries, and so forth, the idea that they would put in a statute a standard of primarily managed and controlled in one jurisdiction is just foolhardy in the extreme. As I will explain later in this lecture, it's not as, the idea that that's being proposed is not as scary as it may seem. And the reason why it's not as scary is that these are very much sort of opening gambits, opening offers for what the rule will eventually be. So it's the point being that that middle category has been hotly criticized from all directions on the political spectrum, and it hopefully will not find its way into a new bill if in fact the new statute is enacted. So this is important because it is not as, even though the details are problematic, as I just explained, it is not something that divides members of Congress very sharply in political terms. Okay, current state of play. All that from before, as I said, the good news is you don't have to remember any of it. And now I will give you a second reason, first being that you can do what you want, remember it or not. The second reason is that the current administration is not even pushing Congress to pass those bills. This is just as of the last week or two. The White House is negotiating with senators to just pass a special 15% of book income minimum tax. But of course, that, in my opinion, is even, and in the opinion of many other tax people who are tax practitioners and active in tax policy, it's a terrible idea. By the way, when I say they're negotiating with senators, the Congress, as all or almost all of you surely know, any proposed bill has to be passed by a majority vote of the Senate and the House. The House is majority Democrat. The Senate is 50-50. And if it's 50-50, the vice president casts the tie-breaking vote. So because the vice president is Democrat, the Democrats control the Senate, but they only control it because it's 50-50 and Vice President Harris can come in and cast the deciding vote. If one Democratic, so I'm sorry, that's actually a separate issue, I apologize. What the administration is trying to do is to get some Republican senators, and the reason for that, and her disquisition on US political institutions, is the filibuster in the Senate. In the Senate, there's a special rule that applies almost all the time. There are certain actions, items that are voted on by the Senate that the filibuster doesn't apply to, but the filibuster requires a supermajority, more than a 50% majority, depending on the day of the week and the issue, you know, somewhere around 2/3. But I mean, depending on, there are always proposals to change it, but in any event, it's a supermajority. And in order to get a supermajority, therefore, if this bill would be subject to filibuster, that is to say, subject to the right of any senator to get up and start talking and prevent any vote on the bill, then the proponents of the bill have to recruit a supermajority of senators. And since it's 50-50, they would have to recruit some Republican senators. So because of that, that's brought the White House to the negotiating table. And they're negotiating, they're saying, look, let's just leave aside all that complicated stuff that gives everybody a headache just trying to read. Let's just pass a minimum 15% tax measured by book income. That is to say, in the US, generally accepted accounting principles, and then, or in other countries by, you know, accepted norms of accounting that are used for financial reporting purposes rather than for tax reporting purposes. And by the way, for those of you who are really paying attention and are sharper than I am, this is a sort of suggestion here of what's coming. The 15% of book income sort of kind of sounds a little bit like the proposal for the Globe tax, the Pillar 2 minimum tax. And I think, pardon me, I was turning down an electronic device that was making noise. So this is really a kind of shadow entry into the US tax realm of the Globe Pillar 2 concept of having all countries agree to a minimum tax. The problem with using book income rather than tax income is, first of all, it's super complicated because it would require allocations between US and non-US operations. The financial accounting has different norms and purposes than tax accounting. And it also gives authority to make tax rules to non-governmental parties, which makes people uncomfortable, including me. other thing, and this is something that some of the Republican senators have said, it's viewed as just postponing attempts to enact the full array of corporate tax changes that we just very briefly summarized. So the Republicans are saying, look, you're just going to be trying to pick our pocket again in the fall, in November or whenever. So it's probably not, given that it's substantively problematic and that it's politically not very appealing, it means that it's probably not going to go anywhere. Another point is the Senate Finance Committee chair, it's a Democrat, announced he was going to release a new international tax framework. So bless them all, we now are going to have yet another comprehensive approach to changing US tax code. And what is probably going to happen, this is how it works on Capitol Hill in Washington, DC. He's going to consult this gentleman who's the chair of the Senate Finance Committee, is going to consult on the side privately with influential Republican senators, and they're going to really work a deal. They're going to make a deal. So I don't predict they're going to make a deal, but I think there's a good chance, just from my inexpert view of it, from my experience watching these things over the decades, is there's a good chance, whether it's a 1 in 3 chance or a 2 in 3 chance. There are too many details that I'm not familiar with, but the point is that when the chair of the committee says we're going to have something out in the next few weeks, what they're really doing is they're going to spend a lot of time talking behind the curtain with their colleagues on from the other party. And that means that there's a good chance that there will be a compromise. And if there's a compromise, then it'll be passed. And the other dynamic, and maybe this is too much information for those of you that aren't political junkies, but if you're a senator from say a state like Florida or Texas, which is sort of strongly Republican, you cannot be accused of submitting to the demands of Joseph Biden. That's just like, people in a playground allowing themselves to be bullied by someone who is low status. So the process of negotiation in the committee allows those senators who do not want to be accused of submitting to the demands of a Democratic president. It allows them to make compromises without having to be embarrassed. The last point, as I said, the filibuster, this is actually interesting. I apologize if this is, again, too much information. The budget reconciliation rule is the most important exception to the rule that any vote of the Senate has to be by a supermajority. If someone wants to filibuster, if someone wants to block the vote, the only way to force a vote is to have a supermajority. And the exception to that rule, to that filibuster rule, is when there's a budget reconciliation, which means when the US Constitution requires the Senate and the House to approve the budget each year. So if something has to do with just approving the budget, it is not vulnerable to filibuster. So what has happened is, and this has happened, the Republicans and the Democrats have each done this, have like they pack their budget bag, but they put things in the budget bag that are really not in the nature of budget issues, so that they can avoid the filibuster blockage. So there's always a risk that will happen, but that's beyond my experience to predict how likely. I do know it happens more than infrequently, but I don't know if it'll happen here. Here is my thought, and this, I hope I don't offend anyone, and I hope I don't seem superficial in my thinking. The real game is the US, France, Germany, etc. And I certainly, I can't list the 30 or 40 countries that should be part of that list, which is why I put in the etc. on the one hand, and then the Netherlands and Ireland, and I would include Luxembourg and perhaps some other countries as that second category. The real game is between, as I say, US, France, Germany, and then countries such as Ireland and Netherlands, which are stable, well-governed, countries, but which are viewed and appreciated as hubs for business activities because they both have sophisticated and favorable tax rules, and also, again, have very highly competent governments and highly competent tax authorities. And that's where, like with the Pillar 2 minimum tax thing, you know, the Irish rate is 13, I think 13 and a half, and the proposed minimum rate under Pillar 2 is 15%. It's really just, I think, to tip the balance. I think the real fight, the outcome of which is uncertain, is the fight. And fight is not quite the right word. The Netherlands is my second favorite country, so I don't want to say I'm going to fight. I want the US to fight the Netherlands, but the tug of war is between these two very respectable groups of countries. The battle against the really abusive countries that facilitate really deeply abusive arrangements. Maybe shouldn't put Malta in there, but in any event, I was in a hurry and there it is. Cayman Islands, Jersey, Bahamas. That under BEPS, you know, starting back in 2015, that is just a war that is just going to be fought, and at the end of the day, mostly won by the countries, be they Netherlands and Ireland or the US, France, or Germany. So that the point here is that all the stuff we were talking about, guilty and beat and everything else, those are really issues. They're not high stakes because they're really just, there's too much income being taxed. Too much of this multinational's income is being taxed in the Netherlands. More of it should be in the US, or more of it should be in Italy or Germany, where the customers of that multinational are. So it's really just, as they say in the US, inside baseball. It's not a high stakes game. The high stakes stuff is the fight against the outrageous abusive arrangements involving the Bahamas and such. So that's just my 2 cents on the matter. In other words, I think the risk in terms of what the US Congress and the US president might sign is that they do stupid things, not that it's not like there's proposal A, which is radically different than proposal B, and one is good if you believe certain precepts, and the other is good, and the first is bad if your belief system is different. It isn't a fight of good versus evil. It's really just, I have my fingers crossed that whatever they enact isn't stupid. As I say, I don't think they're really big world-changing issues at stake. I do add, to make it more interesting, China is signaling it wants to not be bound by the global minimum tax. I just happened to see that recently. I don't know what that thinking is, what thinking that attitude is attributed to, but it just goes to show you that it's if I could say, it's the big trading firms that are more or less responsible in the commercial realm that are debating issues, and that's where that is. And I didn't really mean to do that. How did I do that?
That's magic. Yeah, you're close. You're very close. Please.
Okay.
Yeah.
So now that I've wasted 30 or 40 minutes of your time because I like to hear the sound of my voice, I wanted to get into some proposals that are coming our way that have an indirect, let me step back a moment. The balance of this, besides my pathetic attempts at humor, will consist of just a discussion as shown here of domestic tax proposals of possible relevance, and then of some developments in case law and a few statutory changes that are of interest. It's surprising, Rustam, I spent a lot of time trying to find exciting news on the tax front, and other than the negotiation relating to the G7, relating to Pillar 1, Pillar 2, and the things we just talked about relating to modifications of the 2017 Act, there's not a lot of excitement in the air. But in any event, the rest of this lecture will be just trying to find something interesting to say about what's happening in the US outside of the realm of the BEAT shield set of issues. So President Biden is proposing an increase in the top personal rate from 37 to 39.6%. That's not a big deal. It was until 2017, 39%. What's important is he's going to lower the income thresholds for when those top rates apply. So instead of applying at $500,000, they'll apply at $380,000. So they effectively is a more substantial increase among very high income taxpayers. This is significant, increasing the C Corp tax rate to 28%. Just really quickly, in case someone can't, if a non-US person, corporations and limited liability companies and partnerships are always done at the state level. There are no, other than federal banks, there are no, and other specialized entities, there are no entities that are formed under federal law in the US. They're all state. So a state, you form a corporation, and then the tax treatment can, although there's a presumption that you get a certain tax treatment, you can elect in or out under the check the box rules. So when I say C Corp, I mean a corporation that pays its own taxes. You can elect, even if you form a corporation under Delaware, Maryland, Virginia, California, you can elect C Corp you can elect S Corp status if you meet certain conditions. And the S Corp is essentially a pass-through. So we're not, the S Corp rules have no relevance to any of the international tax issues we're discussing here. So when I say C Corp, I'm just talking about a corporation which pays its own taxes and has no pass-through tax characteristics. So they're shifting it from 21% to 28%. I think that's a big mistake, given how much tax abuse I have am responsible for over the last several decades. The tax differential is an invitation to aggressive tax planning, and I thought that getting it down to 21% was just the smartest thing the government had done since it, put up streetlights on major intersections. All right, so taxing carried interests at ordinary rates. For those of you who deal with this, it's actually a significant matter. If I'm an entrepreneur, and let's say I have a partnership or limited liability company, and I have person A is the entrepreneur who's going to do all the work, and person B is the person with all the money that's going to finance it. Person A often gets they'll get, in addition to a capital interest, just X% of the venture, they'll get what's called a special carried interest, which is just if the thing outperforms a certain threshold, they get an extra bonus. That's not quite the right word for it. So the US tax rules right now, that when the entity that these two people organized and built becomes valuable and they sell it, that carried interest gets taxed at capital gains rate, which are barely more than half the rate of ordinary income. So they're changing this. If you have income over $400,000, your carried interest gets taxed at ordinary income rates. That's not a big deal in terms of broad policy, but it's important in terms of how frequently that arrangement is put in place. So that's going to affect a lot of deals in the US, and then obviously necessarily, but to a lesser extent, deals involving non-US stakeholders. Eliminate the like-kind exchange deferral rules for gains over $500,000 per taxpayer. The like-kind exchange rules, if you exchange like property for like property, if I own a $100 million office building worth $100 million, I can, if I sell it, then I have to pay on the gain based on the difference between what I sell it for and what my tax base is. If I, instead of selling it for cash, I exchange it for other real property, which is considered like kind. Real property is a broad category for like kind purposes. Then you just never pay the gain. It's just like contributing something to a corporation in exchange for stock. And they're eliminating that. That is something that could very likely affect international, non-US taxpayers. something on the procedural side that's rather important, expand broker information reporting with respect to crypto assets. I don't know much about crypto assets, but it just, walking down the street, looking at the headlines on newspapers, that that's a growing category of assets and a growing category of, financial practices. So that's going to, something like that will come into play almost necessarily. So these are proposals. These are not things that are have either happened or are extremely likely to happen. I don't have an opinion about their likelihood. Other miscellaneous rules. I'm sorry, this is more tiresome stuff. I'm going to try to get through this in less than 60 seconds. These are things we didn't talk about, but I just want to remind you, if you're sort of try to at least have a top level picture in your head of US rules that are important. FIRPTA has to do with real estate. If a non-US person sells real estate, FIRPTA, it's called Foreign Investment Real Property Tax Act. FIRPTA requires the agent handling the sale to withhold 50% of the sales price. So if let's say you have something that you bought for $100, non-US person buys a building for $100 and it appreciates to $120, so they sell it. Well, their gain is only 20, but if they don't follow the procedures, the closing agent will have to withhold 15% of $120. They'll have to withhold $18, almost the entire amount of gain. So what you do is you submit well in advance, at least 2 months and probably 3 months if you can, in advance of the date of the closing of the transaction, Form 8288B, and you apply to the IRS. You show them what your tax basis is and everything. It's very important to do that. If you don't do it, you can file for a refund, but then you have to wait. And particularly with the COVID, the IRS has just become frighteningly dysfunctional. I was involved in a very substantial tax refund case of $500,000, and there were no difficult tax issues. There just was no controversy, and it took more than a year to get that refund. Unbelievable. They lost it. It was terrible. It was a nightmare. So you really want to do as much as you can to get ahead of, and anticipate problems with over-withholding. U.S. Real Property Holding Company, it's for a company that owns a substantial amount of real estate assets, whether U.S. real estate or foreign assets. Again, a 15% withholding on the sale of stock. And it's just something to be aware of when you're planning. And it's really just a reminder for those of you who might come across that. FDAP is fixed, determinable, annual, and periodic. It's basically, if you're a non-US business, you get taxed on either income that is effectively connected to a US trade or business, or if it's US source income that is annual, periodic, fixed, and determinable, which is essentially passive income. And you want to, the situation I just described where the person was asking for a refund of more than $500,000, that arose because the person, who's a very sophisticated person living outside, a native and resident of another country, just wasn't mindful of the rules relating to FDAP income. And so you want to make sure your clients, if they are buying, say, stock on the New York Stock Exchange, that they do everything they need to make sure that they don't have, if in fact they're entitled to have no withholding, they have to make sure that the paperwork is in the hands of the IRS and in the hands of the US agent, in the context of stock on the New York Stock Exchange, in the hands of the real estate brokerage firm, so that you don't have withholding. Okay, that's just a reminder of other rules. This is, I made this up, and this is a silly thing, and if you look at the first acronym that I can't Rustam, being from Russia, is very puritanical and would object to any vulgarity in this lecture. So I'm not going to explain to you what the acronym for this sentence is, but this describes the U.S. environment in terms of debating tax policy. It's a lot of fighting over things that are not really of great principle. Anyway, enough of that. Okay, we're getting towards the end of the lecture. That's another bit of good news. And these are changes, actual cases that have been decided and or laws that have been enacted and are current US law or current US administrative practice. So these are potentially critical for some of the people in this seminar. The IRS recently issued draft versions of what are called K2s and K3s. If you're a US partnership with all US partners, you get the partner gets a copy of the partnership return, and it gets what's called a K1. And also, if you were a shareholder in an S corp, as I said before, it's a corporation which is elected to be taxed as a pass-through, as if it's a partnership. You get a K1. And so K1s, any tax attorney, you can wake them up in the middle of the night and say K1, and they'll, talk for 10 minutes. K2 and K3 relate to distributive shares of income, deductions, credits for non-US resident partners. And the reason why this is just worth noting is that it's the trend towards much more disclosure is gathering speed. So, and that's probably a good thing, so that the aggressive tax planning is just done within the bounds of a sort of, honorable, acceptable range. So the K2 and K3, essentially that's interesting because it reflects the IRS being more aggressive in collecting information relating to non-US owners of US pass-through entities. Related to that is the Anti-Money Laundering Act of 2020, which came into effect January 1, 2021. It requires the reporting of beneficial ownership of entities that are registered in the US. And this is interesting, within 2 years of the date regulations are issued. So heaven knows when those regulations are issued. This is a huge change. I've been practicing law for too many years to think about. And it just seemed normal that there would be no disclosure of ownership because no state corporation offices ever asked for it. So the idea of having to disclose the identity of beneficial owners is sort of a shock to me. But anyway, I understand why, and that's a big, big change. There is a country, this should have been on the last slide, a country by country reporting bill is circulating in Congress. For those of you who want to look at it, it's HR. HR stands, all the bills are being considered by Congress are either HR, stands for House of Representatives, or S, and then a number standing for Senate, obviously. So HR 1786, and this is very much just in keeping with the gathering trend with the BEPS movement towards enhanced country by country reporting. Okay, now here there are two cases. It's surprising there were not a lot of cases of great interest to international tax community. This is really important. It has to do with filings, procedural compliance. A foreign corporation that did not timely file US returns, and in fact didn't file them until after the IRS issued a deficiency, lost the ability to take certain deductions. What a disaster. There's just, if a non-US entity has any business that is potentially taxable by US tax authorities, which means it's either FDAP, that fixed determinable income, passive income, or effectively connected to the US, you better have file those returns. It was catastrophic for this Adams challenge. And then the last case, and this I and probably half or more of the people on the seminar could talk for hours or days about principal purpose tests, substance over form, and so forth and so on. It's for those of you who would like a little non-US attendees of the seminar that want to feel a little schadenfreude about the US environment. It's a mess in the US there. The whole idea of substance over form, there's actually, sometimes there's a statute or a regulation which has been formally, in formal terms, is as controlling as a statute that say principal purpose, when in fact the courts will say, well, you don't really mean principal purpose, you just mean one of the purposes, or they'll say one of the purposes, and the court will say, a different court will say, well, it's not really a principal purpose, even though it's a pretty important purpose. So it's very murky, and in the US as much or more so as it is in the international environment. Substance over form does this case, which is a court of appeals, as you all probably know, and all federal tax cases are decided in federal court, either through either the tax court, or there's some jurisdiction rules. You can either file for a court disposition of a dispute with the IRS, you can either file it in tax court or you can file it in the federal trial court. In either case, if you don't like the decision of that court, you appeal it to one of the 11 US circuit courts. They're geographically laid out over the US. So they are just below the Supreme Court. If you don't like a federal court of Supreme Court. In any event, so this is a high level appeal. The Ninth Circuit includes California. It's silly to say it's one of the more sophisticated. They're all very sophisticated. I mean, people, this is very high level stuff, and I am often surprised at how sophisticated these Court of Appeals judges are in their opinions on tax issues, which is a very narrow, specialized area, and oftentimes they come across as much wiser and much more sophisticated even than the judges on the U.S. tax court. In any case, in this case, I don't know if this is a good decision or a bad decision. It's just another example of what a mess the substance over form debate is in the U.S. and the principal purpose test debate is in the U.S., where the court said, look at the statute. It says you can do this, and we don't care. The purpose of substance over form doctrine doesn't apply. I think it's not a clear line between where it does and doesn't apply based on the language of the statute. But in this case, the Ninth Circuit, which tends to lean a little left, it's a little bit surprising that they took the side of the taxpayer on this. So that is it, and that is my name, and it looks like I spelled it correctly. And I'm going to stop sharing and yield the floor to Mr. Vakhitov, and I thank you all for your polite attention.
Okay, David, thanks a lot. It's really amazing first to squeeze so much information and rather understandable and straightforward manner within 1 hour presentation. So really, my applause. I'm not really seeing this often when US tax expert can explain something in plain language. Definitely this Leiden training when you had to interact with people from other countries did some good work. Well, in respect of principal purpose test, my, well, not really question, but rather invitation for discussion. In Russia-US double tax treaty, for example, there is no principal purpose test. It might well be that the Russian court will apply some domestic anti-avoidance doctrine and domestic law, which would effectively be more like principal purpose test. But when you mentioned that US court would decide on principal purpose test. Is this the common policy for United States to include this principal purpose test provision in double tax treaty? Maybe with Russia, it's pretty old one. It's like 92, so almost 30 years old. So
I don't know. If it's not in there, it is not because they forgot, because it is always at the front of the mind of any revenue agent for either a, okay. I'm looking, I have a list here of differences between the US and the OECD model. And I thought there was okay, well, it does say the limitation on benefits rules differ from the US and model treaty. I'm just looking at my notes. I don't know what it says. I will tell you that there is an anti-abuse provision relating to hybrid entities where you have something that's a pass-through entity in one jurisdiction and a not pass-through in the other. So there is some hint of that. I'm sorry, I'm not giving you a very good, I will tell you there isn't a court in the US that has jurisdiction over federal tax issues that would hesitate to use the US precedents and US rules to judge an international dispute.
okay.
I'm just thinking out loud now. It's possible that the US is happy to have nothing in the treaty so that the judges in the US can just apply US law. I don't know.
That's really creative. Good. Should we go through the questions which have been posted by our attendees?
I see.
The first one is philosophical, rather philosophical question. Are US companies happy with taxes that you described? So,
well, they're happy with the 21% rate, and it depends. You know, it depends, because if you're a General Electric, let's say, which is in the traditional economy, and they're all the major trading countries, and they're super sophisticated. For General Electric, it's all part of the day's work to make good choices at the margin, you know, at the edge, to make it a little better, a little worse. So in a sense, that General Electric type company doesn't care. They just do whatever. Like, just tell me what the rules are, I will figure out a way to live peaceably with the rules. Then you have like Apple. You know, the Irish, the EU Apple decision is, there are many, I say this with respect because I've read many ECJU cases and they are a very competent court, but the EU Commission ruling was, I'm sorry, let me step back. The EU Commission ruling was totally wrong. It just was indefensible. So in a sense, the Apples, the people in Google and Facebook, they are fighting this big battle with digital services taxes, with decisions like the Apple decision, which are incorrect. So I think they don't care so much about this, even though they probably do. But certainly transfer pricing issues are much more important for firms that are with the profit model based on digital functions. And then another category are the smaller firms. You know, I have a friend, his family has a manufacturing firm. They have 2 factories in India and they have a factory in the US. They don't spend so much time planning this stuff. Perhaps they should spend more time. So I don't know. They are very unhappy with Pillar 1, the idea that Pillar 1 might be enacted. I don't think there's a lot of emotion about the other beat and guilty stuff. It's just, you know, it's another day, same headache, different day. Is that Okay, what are the grounds to select? Oh, the second question, what are the grounds for selecting 80% as the resident, threshold rather than 90%? That is just purely arbitrary. There was no principled thinking that went into that. It was just more than 60 and less than 100. Okay, Mr. Markov.
That's an interesting question. That's also kind of philosophical question, but that's very useful to discuss, because this increase of corporate income tax by 20, by fourth, by 1/3, depending how you calculate this. In some countries, there would be questions from like, guys, what on earth is happening? Is this World War III, or why do you need such a sudden increase of taxes? What was the response of Biden's administration? Why they well, suddenly, I'm not really very much into it. It's very interesting when you explained all these small things which relate to the final outcome, including who is the, what is the well, balance between Democrats and Republicans in Congress. And in respect of this increase of tax rate, what was the justification basically?
Well, partly it's just traditional politics. The party to the left of center thinks that taxes should be higher, that rich people should pay more, and so forth. And to the right, the thinking is, look, it's not a question of morality, it's a question of policy that gives incentives to engage in desirable behavior. So, as a friend of mine in the US, they have this Black Lives Matter movement, which is very disturbing. So he jokingly said he's going to start an organization called Thoughtful Strategies Matter. So in the context of taxation, 28% may be a good idea, it may not be a good idea, but asking should rich people pay more is a meaningless question. The question is it a thoughtful strategy for achieving much more important outcomes than some, moral pleasure in seeing a rich person pay more.
Okay.
Can I go on to the next question?
Yeah, and there are also some questions in chat. I would like to ask everyone willing to submit question, please type it in question answer section, because in chat the purpose is slightly different. Anyway, David, please go further.
What should I do? I'm reading the question.
Yeah, let's go to the question of Damir Achubayev.
Okay.
Taxation.
Let me read that. Well, the question is, since there's no principal purpose test in the US-Kazakhstan treaty, how does the BEPS Action Plan 15, how could that be mitigated with respect to services coming from a UK-based company? That's a complicated question.
Yeah, that's rather so. There is a US-based and UK-based companies. So there is a US company supplying services to Kazakhstan, and this is in Delaware. And from looking at the US from this part of the world, Delaware is often perceived as zero tax jurisdiction.
As you and I discuss, it's zero tax. States, Delaware, Maryland, California, they impose taxes, and Delaware imposes no tax. They've chosen to impose no tax, so there's that. But it's going to be a federal tax issue. The question here is about UK-based services. If you're trying to avoid British taxes, the US would be happy because then it gets taxed in the US. I guess but it's never that simple. I don't know. I'm sorry, I just can't quite get an anchor to give a useful answer to this question.
Well, maybe in a way this relates also to my question, because if Kazakhstani tax authorities will try to challenge application of benefits under Kazakhstan, United States and Kazakhstan, UK double tax treaties on the basis of principal purpose test, the formalistic straightforward answer would be there is no principal purpose test under, I'm just presuming this. There might be no explicit principal purpose test under Kazakhstan US double tax treaty, as there is no under Russia US double tax treaty. Both tax treaties, they have been concluded in early 90s, so I wouldn't be really surprised if they're similar. But as you mentioned, just as in United States, I presume Kazakhstani courts would not be very hesitant to apply some domestic anti-avoidance doctrine to challenge what they think is aggressive tax planning. And well, I'm not sure what is the situation under Kazakhstan. Well, Kazakhstan and United Kingdom, they both opted for MLI, so they should apply principal purpose. The question is only whether they selected each other. So if there is a matching between Kazakhstan and, but even in case if for some reason there is no principal purpose test effective under Kazakhstan, United Kingdom double tax treaty, I wouldn't really hope that Kazakhstani tax courts and tax authorities would allow some aggressive tax behavior on the basis of absence of formal ground for apply principal purpose test. That would be my wild guess, although I'm not a Kazakhstani tax expert. But in principle, this is a Kazakhstani tax question.
Right now, maybe they could have access to transfer pricing principles and say that it does not meet the standard for arm's length pricing, and that could be a second challenging, especially services, you know, where the services take place. Surely there's a digital aspect to it, and I don't know.
That's a good bridge to the next question, which was asked in chat section. What do you think about taxes on Google and Uber, which are now established, introduced in some CIS countries? So what do you think this is useful? And just clarify what is going on in former Soviet Union, let's say, region. Some of the countries introduced VAT on digital services. Russia, for example.
I'm sorry, I didn't hear you. They introduced what?
VAT, value-added tax on digital service, digital goods and services. Russia did it 4 years ago. Ukrainian parliament just voted on this bill. And this is being applied in Europe for as of 2003, I believe. So VAT on digital, this is one thing. And sometimes it's called Google tax, but technically this is not a digital service tax, which is being introduced in Europe. I believe Russia is the only front runner. So Russia is just discussing introducing digital service tax, 3%, just following the French model. But to my knowledge, there is no former Soviet Union country which really introduced digital service tax at present. So most likely this is about value-added tax on digital goods and services. And I believe in the US, if somebody from Kazakhstan, for example, sells digital service to US person, would this entity subject to US taxation and sales tax? What is the replacement for VAT?
Well, that's an interesting question. If the treaty just has the permanent establishment rules of the model treaty or a predecessor treaty, then the answer is easy. There's no permanent establishment and therefore no tax. What is very interesting is this US Supreme Court, in a very unusual decision, they just changed their mind after 20 years. A decision 20 years earlier said California could not tax Amazon. because Amazon is based in Washington, the state, a different state. And then in this case called Wayfair, it actually involved North Dakota, which is North Dakota, for the Russians in the audience, is the Siberia of the United States. Anyway, so North Dakota said, look, it's too cold here for anybody to come in person. So everybody sells electronically. We have to be able to collect essentially VAT tax. It's called a sales tax, but it's a VAT tax, where you, even though it's all within the US, so this issue between different US states, North Dakota, South Dakota, California, New York, it's the same issue as the Wayfair case, and what the states are in the US are struggling with is the same as the problem with digital intangibles in the international arena. And so after this Wayfair case, which is now 2 years old, if that were to apply, it doesn't, but if it were to apply, then Kazakhstan would have to pay taxes in the US.
Mm-hmm.
Turning to the reality here, to me, the digital service tax, you know, there's a good argument, policy argument, that a consumption, which it's a consumption tax, that consumption taxes are better than income taxes, but that's a whole different discussion. If you assume that you can sort of maybe kind of justify it, my very passionate concern would be for horizontal equity. If you tax Google, you have to tax a domestic company the same. And if you tax Google, you have, which is $1 billion company, you have to tax a small company. I'm actually, if you'll let me mention, I'm hopefully this week or maybe this weekend finishing a paper which I hope to have distributed in the next few weeks on this issue. And so that's why I say I'm passionate, because I've given it a lot of thought. Like I say in the paper, if under the pillar one, the digital unified approach applies for companies that meet revenue and profit margin levels, that's ridiculous. Digital functions are migrating through the whole economy. My son works at a bookstore in Los Angeles. It's one store, and they have the same software as Amazon does for selling books. The digital function, the digital capacities are migrating to bookstores in a neighborhood in Los Angeles. So the idea that it should only be companies that have $750 million worth of sales is absurd. And you could have, you know, Amazon has, you know, in Germany sells 300 million and they're above the threshold. Then there are, say, four other companies from outside Germany that sell much less, but if you add them together, they sell more than Amazon. So Amazon pays pays taxes in accordance with the unified approach. And these other three companies, which together sell more digitally in Germany, don't have the, you know, it doesn't make sense. So the horizontal equity is the big problem for me with digital service tax.
Okay. Well, thanks a lot. Thanks a lot. I believe we did. Well, okay. There is a question from Niels Rovers, our resident, let's say. So Niels is very persistent in attending all these lectures, and I really appreciate this participation. So Niels is asking how it would be possible to buy your new paper, which you're going to produce, or how to print otherwise.
I will send it to you. You certainly, I'm almost done, Robert. I will send it to you without any charge whatsoever. I guess if you can read it and if you have any comments, I would be grateful to hear your comments. If you would send me your email address or send Rustam your email address, I'm sorry to ask them to do it to you. I take that back. If you send me your email address, my email is db David Borinsky, so it's db@complexorder.com. And I will send my slides with some typographical errors corrected to whoever asks for them. Maybe I'll send it to you, Rustam, if you want to give it to
well, what we can do, I distributed your brief bio in the reminder, and I will repeat it in the follow-up email with video recording of this session for those who couldn't attend it live. And there will be your email there. So everyone who is willing to obtain your slides, they can just communicate directly and also could ask for the paper. I think that would be the easiest solution. But I will be happy to pass on your requests to David as well.
Okay, thank you very much.
Okay, well, thank you once more. Thank you once more. In Kazakhstan now it is, it's almost midnight there actually. So 5 hours difference with the Netherlands. It is quite late. It is quite late in some parts of the world. And thanks a lot, David, for brilliant presentation. Next week, we are going to have a conversation with tax director of one multinational group, Devrim Türker. He is also graduate from Leiden. So if there would be questions, most welcome to send them, and feel free to communicate, David, for questions related to this session.
Also, I'm going to be in the Netherlands in about a month and a half. So maybe if you're going to still be there, if you're not on vacation, then you and I can get together.
Great. Sure. And Niels could join. So if Niels is not flying to China as he frequently does, yeah, then we can get together. Thank you. Thank you once more. Bye.